Welcome to Real Estate Raw. My name is Bill Ham, and this is our regular session on. This is our regular session every Wednesday at 2 o'clock. Thanks for joining me. If you're new to the group, please announce yourself. Let us know who you are and where you're from. And if you have any questions or comments, certainly post those in chat right here. For today's presentation, I'm going to answer all questions at the end of the presentation. We do this every single week, Tuesdays. I will have Monica Wyndham joining me. She is my real estate asset manager and property manager extraordinaire. She's also the CEO of our management company, Echo Residential. So if you have any specific management questions or operational questions, she's a wealth of knowledge. Certainly ask her. All right, again, thanks for joining us here. And for the recording, hi, this is Bill Ham, and welcome to Real Estate Raw. Today, we are going to be doing a 2022 review and 2023 outlook. Sort of what did we see go on in 2022, and what can we expect to see in 2023? Those of you who are not familiar with me, I have been in real estate for about 18 years now. Started off single family and duplex type assets in Middle Georgia. Over the years, I grew my portfolio into a much larger asset class, started doing large multifamily, built a very large portfolio over the years, did a lot of creative financing and did a lot of syndication as well. So I've done both of those and a fair amount of experience in the business. So I've been through the market cycles. I've seen the up, I've seen the down, I've seen everything in the middle. And so today I'm going to kind of take a look back at 2022. Let's kind of do a review. I'll give you my opinions, and then we'll kind of look forward at 2023, and I'll give you some suggestions as to what I believe you should be looking for and the things that I'm certainly going to be looking for myself and the way I'm going to be doing business going forward, multifamily business. So I'm going to share my screen here in a second, and I've got a lot of information that is factual data. And a lot of charts and graphs, things that I want to show you. Now, for this presentation, I will clearly stop and tell you when I am giving you my opinion. For example, 2022 was a hell of a year. Fact. 2023 is going to be a hell of a year. Opinion. Right? So like that, fact and opinion. But I will certainly tell you when I'm giving you my opinion on the factual data that I am presenting to you in this presentation. All right. So let me get the screen share going on if I can do that. Not sure how to do that on this. So, all right, anyway, so going forward, 2022, we had a lot of interesting things going on. Let's see, hold on, here we are. All right, live share, here we are. No, it's not gonna let me do it. All right. So anyway, 2022. Let's see. 2022. If I can get the screen to pull up. The catch here. I want to start the story off with COVID. And I know that's not what everybody wants to talk about, and that's a dead topic. Certainly, I understand that. But going forward, we really kind of need to look back at what happened. All right, there we go. I think I'm sharing the screen. So if you can see that there. This is what occurred starting into the year of 2021, 2022. So I'm going to go all the way back to the beginning of COVID when we first saw the advent of COVID, because that explains how we got here and explains the market and why we're in the market that we're in now and why we're seeing some of the things that we're seeing now. And this is also why I teach my students multifamily market cycles. All right, so what I'm showing you here is the Board of Governors, the Federal Reserve System. This is their data here. What we're discussing is M1, all right? That is the amount of money that is in our system at any given point in time. This is the amount of money that the Federal Reserve places into the world. All right, so we're going to start our conversation off with COVID. And what occurred there was we ran into something that we had never dealt with before as a society, as a country, as politicians. They didn't really know how to react to this. We had never been through this in modern times. So what they decided to do when the advent of COVID came along was to put America into lockdown. We know that a lot of countries went into lockdown. Some stayed there longer than others. Even parts of our own country stayed in lockdown longer than other parts. So the government put everybody in lockdown and said, stop working, everybody stay at home, shelter in place. They believed that was going to destroy the economy, that everyone would be not working, everyone would be at home, and this was going to absolutely wreck the economy. So what the Federal Reserve and what the government did was to immediately start issuing stimulus money. Now, I'm not going to give you a lot of opinion on the right or wrong of that, but I will kind of discuss what actually occurred. So as we went into lockdown, late 2019, early 2021, or into 2021 with the COVID, the feds started to pump massive amounts of cash into the world. They started sending out everyone a stimulus check. I believe it was about $2,000 or so a person for general stimulus, but they also gave out the PPP loans, the Paycheck Protection Program stimulus, as well as a lot of cheap money from the Federal Reserve, the SBA, the EIDL loans, the disaster type loans, these sorts of things. So it was a tremendous amount of money put into the world at very low interest rates very quickly. And in a lot of cases, they were not loans, they were just straight stimulus. All right, so let's take a look at that and look at the chart that we have right here. So this is a concern. For the last 40 years, since 1960, we've seen a slow increase in the amount of money that the government is putting in. Slowly until 2019, and look what happened. We went into to 2020, right? So there's February 20, January 2020, and this chart is in billions of dollars. So that you can see roughly we had about $4 billion in the U.S. economy in circulation. Within 1 year, we jumped to almost $18 billion in circulation. And you can see that there. So going from January to January, give it a stop. We went, you can see there, massive amounts of money. So 18 billion dollars from $4 billion. All right, so let's kind of discuss that for a minute. That's dramatic. First comment, if you made some money in 2021, 2022, don't get cocky. Everybody made some money. If you got a little money in 2021, 2022, don't get cocky. Everybody got a little bit of money in 2022. 21, 22. That's why we saw stocks go up. We saw real estate go up. We saw crypto go up. We saw all these things go up because look here, look at the amount of unprecedented cash the Federal Reserve put into the world. Everybody had money to invest in something. All right, this is going to be a problem because now the Federal Reserve has to raise the interest rates in order to sop up and mop up all this extra cash they spilt into the market. Okay, so we look here at the very end. So here's April 2022, and then as you can see down towards the end of the chart here, November 2022, the amount of money in the world is actually starting to recede a little. Now that's a minute scratch in the amount of capital that was placed in the world in general. So when are we going to see the rates come down? When are they going to come down soon? We can certainly discuss that, but we have to get all of this cash brought out of the world. So if you haven't seen this chart before, it's certainly worth paying attention to. Look at these gray bars here. These are all recessions, and I'll show you some other charts here where this coincides with federal rates. So typically speaking, what you see is the Feds raise the interest rates, and that sort of suppresses the economy, possibly even putting us into a recession. You can see one of the widest recession bands here was the 08 recession, and that was certainly after they raised the interest rates. But look at the amount of capital that was even in the world back through the 08 recession is a fraction of the amount of money that the Feds put into the world in one single year of 2020. So that's going to be interesting how that turns out. But all right, so let's kind of talk about what happened. So it's COVID. COVID came on. M1 increased significantly. We see this here in the chart. Again, a lot of the money was put out through stimulus. A lot of it was the Paycheck Protection Program, and I point to that largely as the situation that we're in today, economically speaking. There was a lot of fraud there. There were a lot of people going out and getting loans and paycheck protection for brand new companies, brand new LLCs. They didn't have payroll. They didn't have much payroll. So there was some fraud in there. But really what I saw was an awful lot of people that legitimately owned companies that all of a sudden had to no longer make payroll. And so their actual profit to the owner, to the limited partners, to their shareholders was highly increased because the government just covered all of their operating expenses as far as payroll was concerned for quite a while, whether the company needed it or not. And so therefore, that's where we saw a lot of the capital actually be injected into the world. All right, so here is a closer look. Here's what the federal funds target rate is. You can see here from 2013 on coming out of the 08 recession, they have kept the rates very low, almost at zero through this point here. They raised the rates a little bit through 2018 through 2019 there. You can see that only got up to about 2.5%. And right now, we're at, according to Money Cafe, we're about 4.25% to 4.5% per the Fed rate. Now, that does not exactly translate into commercial rates. Commercial rates, prime rate, can be a lot higher than this at the moment, depending on where you're at. Fannie Freddie commercial agency type loans are around 5.5% or so, maybe 6%, depending on the deal and the borrower. We're seeing local community banks somewhere between 7 and 8%. So again, the funds rate has nothing to do directly with the commercial rate you're going to get on a mortgage. But you can see here the difference from going from almost 0%, or here in 1 year, going from 2021, 2022 to the end of 2022. Tremendous amount of rate growth right there. Here's another chart. You can see the individual seven rate hikes that we had this year from the Feds, starting in March all the way through December, quarter point, and then they got into those 3/4 point raises, and then the last one was a 0.5 point raise. So you can see the rate going from 0.25 to 0.5 point up to 4.25% to 4.5%. That is a tremendous amount of rate growth in 1 year. All right. And so that is going to have a ton of effect on the market going forward. Now, my opinion, and this is, I'll give you my opinion here. I think this is going to be something like someone rolling a big giant rock right out into a lot of oncoming traffic. All right. The Feds have raised the rates so quickly, and it's such a dramatic rate, by the way, not seen in the last 40 years at the rate that they've increased it. Right. That's such a dramatic rate that I don't believe we're going to have the ability. And I say we, I mean, as in the multifamily market. I don't believe the market is going to have time to adjust very quickly and very easily. And so therefore, I think this rate hike is going to be like throwing that big solid object right into oncoming traffic. The market's going too fast, and we're not going to be able to slow down, and we're going to see a lot of collision with this rate wall that the Feds have kind of thrown out there. I'll talk about that a little later in the presentation, but it's going to come down to loan maturities largely. All right, so that's one of the reasons we had inflation. We had a tremendous amount of inflation because the Federal Reserve pumped a tremendous amount of money into the economy. We also had several other things kind of hit all at once, trifecta, if you will. We had the invasion of Ukraine. That certainly has damaged the economy globally. We've had a lot of trade disputes with China, a lot of disagreements with China as far as the technology and the chips and a lot of the different things that we saw going on in there. That also added to inflation and the supply chain issues coming out of COVID. So we were coming out of COVID for quite a while. And the world took a while to get its supply chains up and running again. So between the war in Ukraine, our disputes with China, and supply chain issues, and the Fed actually increasing money as much as they had, we saw a tremendous swelling of prices, rents, and inflation in general. And so keep in mind, that's what the interest rates are for. The Federal Reserve is trying to get money to flow back to itself. All right, quick understanding of that. The Federal Reserve's raised rates on bonds, and this is a very general description here, but basically the Federal Reserve are going to raise rates on their bonds. And what they're doing is they're trying to compete with the local community bank. If you have a choice, or large investors have a choice of putting money into some sort of account with a bank, or they have the ability to place that money into the Federal Reserve. It is always said that the federal government is a more stable, or the most stable investment, right? So the Feds raise the rates that they're paying out on those bonds, which encourages people to transfer money and save their money in those bonds and not save their money in the checking account. So when the Feds get a hold of the money, they give you a bond, they take your cash, they literally delete the money off their ledgers, literally. So that's how they start bringing M1 down, all right? How that translates into rates with your loan, perhaps over here at the bank, is that the lenders now have to compete for borrowers, or excuse me, lenders' dollars, or depositors' dollars, right? So now they have to raise the rates that they pay out to get people to deposit their money at the bank. And therefore, that translates into commercial loan rates going up when the Federal Reserve raises their base rate. So it's not exactly 1-to-1 ratio, but usually they go up more or less in lockstep. So that's why. All right. So that's kind of what we saw, going into 2022, coming out of the year of COVID, coming out of lockdowns, ton of inflation. So let's kind of see what else we saw going forward here. Those are the four things that we saw really kicking it off. Again, Federal Reserve's raised their rates 7 times. That's going to be to sort of absorb up all of that extra money that they put into the world. Now let's look at a couple of different things here. I said I would show you cap rates and rates with Fed interest rates. So here's another chart. I want to show you this one real quick before we move on. So here are some recessions. You can see here. You can also see here the federal funds effective rate. Now I want to kind of talk about market cycles and how we can apply this to multifamily. All right, notice that every time the Feds raise the rates, we tend to, it's not always, but we tend to go into a recession, and then they lower the rates. Well, that's pretty functional. That's the Federal Reserve saying, hey, there's too much money in the world. So they raise the rates, it deletes the money, it brings the money out of circulation, and therefore we have a cycle of what you might consider poverty for a short amount of time, right? As those rates, and then because of that, they lower the rates, they keep the rates low for a few years, and then slowly they raise the rates again, and typically it triggers a recession. All right, now let's look at that, the rate raising and what they're doing and how that affects other assets. All right, here is, let me find it, go back to, well, there's your federal funds. Let's see, I want to show you, here we are, I'm sorry. All right, so here is historical cap rates. All right, now let's take a look at this. Remember, cap rate is the ratio between price and the revenue that the property produces. I'm not going to go into a full description of cap rate here. I have other videos on that, and you can certainly look it up. But it's suffice to say, as cap rates fall, properties are becoming more expensive in relation to the cash flow or the stream of revenue that they produce. And this is for multifamily. So we can see back since 1994, the trend has been that cap rates are overall on the decline. You can see cap rates starting back off 7.5%, maybe 8% back in 94. Now you notice the cap rates start to decline, and then we have a little incline right here, and then cap rates decline for some years here. Now cap rates declining means prices are going up. So if prices are going up and the cap rates are declining, what do you think the Feds are doing behind the scenes? Are they raising the rates or lowering the rates? Lowering, right? Because if the Feds have low interest rates, that means, or they put out a lot of money, they have low interest rates, the money in the world is less expensive, right? It's cheaper and easier to go get a loan and therefore to borrow. Therefore, properties, due to the low interest rates, will cash flow more and make more, and the value goes up. So you can see right here, as the cap rates are compressing, going down, values are going up. This is the easy money policy of the Fed Reserve right here. And then what happens in 2008? They say, gosh, we've got a lot of inflation going on and the prices are too high. So what do? They raise the rates. And what does that cause values to do? Decrease. It causes cap rates to increase or deflate. So you can see right here, market cycles. Here's where the Feds have kind of had easy money policy. They raise the rates. You got cap rate decompression for a while. They lower the interest rates. Prices go up. They raise the interest rates. Prices come down. And then here we are since the last real rate hike. So 2008 through 2010. Since then, they have had very low cost money, very close to zero rate. And so that now look at the trend of cap rates compressing. What does that mean now? When we see that they raise the rates and we see a decompression of cap rate, well, they've raised the rates more now than they have in the last 40 years, not to the highest level in the last 40 years, but in the highest rate, the highest month over month rate that they've done in 40 years. So what is that going to do going forward? Well, this is Fannie Mae chart here, and they're predicting, severe downside that cap rates won't decompress more than, half a point or so, maybe 1%, 100 basis points. I don't know if I agree with that or not, but again, we can kind of see here the pattern. So going back, looking at the federal funds, let me see where we are here. Yeah, see here, notice when they've gone down, right? Here's the cycle. Here's where they're raising the rates, right? Why? Because this is the cycle where the property was getting expensive and they considered that inflation. So they raised the rates to a point, they tipped the market into recession. And what happened to real estate prices, multifamily prices through the 2008 market? They declined. All right. Why? Because the money got expensive. Why? Because the feds raised the rates. It's very simple. So you see a very small rate increase right here. And then we saw that small little tiny recession in 2020, almost unnoticeable. Okay, and as of this is, by the way, this is a little bit older chart, but I thought it was pretty good graphics. So I'm using it here. Notice this is June of 2022. All right, and that's where the rates were, maybe 1.5%. They're up here about where that E is now, right? They're up here at 4.5%. So the rates are much, much higher now. And look where we got up here, what it did to 08. What do we think that this is going to do going forward? Don't know, but that's a lot of M1 placed into the world, and that's an awful lot of rate increase. They're going to have to keep high to bring that money out. So that's where we could see prices kind of level off for a few years, a year or two, we'll see. So that's a mid-year look there. There was some other good information in the Fannie Mae outlook here. By the way, I'm going to post all of these links in this presentation, so you will have all my research and you'll be able to go back and look at all these different presentations. There's a lot more information in all these than obviously I'm covering here. So a good report here. You can kind of go through forecast national multifamily trends. This was a mid-year forecast from Fannie Mae. So we can kind of see what they were predicting here since 2000 to 2000, all the way out to 2028. So they're predicting a few years forward. So you can see here different things. Look at the effective rent growth. So we see rent kind of bobbling up and down. People ask me this a lot. Hey, Bill, have you ever seen rents go down? Yes. You're looking at it right here in a chart. Yes, rents can go down. So be careful. Yes, I haven't seen it happen lately, but yes, they can. So you can see here, we went into the pandemic. Right, that was right after the pandemic. Everybody froze, nobody went anywhere, everybody got nervous, overreacted a little, my opinion. But anyway, so there's the effective rent, and then all of a sudden rent explodes coming out of the pandemic. One, there was a lot of pent-up demand for people being locked up for a long time, but at the same time, why was there so much rent growth, right? By the way, almost 20% rent growth. I mean, 14% rent growth in 1 year. Did we see riots? Did we see rent riots? Did the renters get angry and go out and burn the building down and flip cars over, all because their cost of living jumped up 20% in 1 year? Wouldn't you think the working class average wage earning renter would be concerned if their cost of living went up 20%? Yet they didn't seem to mind. There were no rent riots. There were no real protests or anybody getting upset. Why do you think? Because of that right there, because of M1. And that should have concerned the hell out of everybody, right? If you're paying any attention to real estate and you've been in this business at any amount of time, you should have noticed the rent going up 20% in 1 year as being extremely dramatic. Now, if you've been following any of my material or you've been to any of my live sessions or boot camps, you'll know that I've been kind of cautioning people over the last 2 years to take it easy with the rent growth. It's great that you're having it, but don't think this is normal and don't start buying assets based on 20% rent growth because it happened 1 year. Well, you know what I heard? Bill, you're negative. Bill, you're crazy. You're a snake bit. You don't know what you're talking about. Rents are great. Rents are going to go up 20% forever and ever. Amen. Well, at the moment, this afternoon, rents have started to slow down. They are still positive growth, but they are certainly slowing down. Again, don't you think it's weird that the average wage earner had their cost of living go up by 20-25%? They really didn't say anything at all. Well, that's because everybody had some money, because everybody had stimulus, they had the paycheck protection, they had the eviction moratorium, all these things. So that was a very, very large outlier event. And I think a lot of people based their purchasing criteria on this M1 chart right here. And I think that's going to create some interesting exit strategies going forward. So anyway, that's what we're looking at here. So you can see vacancy holding pretty steady throughout 2022. That's something I will talk about in a minute. I think we're going to see some shifts in that as well. All right, so, and then you can see absorption and completions. This is also a very important concept to pay attention to. Absorption and completions. All right, completions means how many multifamily units, how many apartments were actually delivered to the market. So how many were built and completed and said, now they're rent ready. The absorption or absorption rate is how many of those units were leased up in that calendar year. So you can see here absorption and construction rates, they kind of go back and forth some. You like 2018, you had a lot more construction than absorption, but then it caught itself up the next year, and then they didn't build as much in 2020. And you have a ton of absorption. Now, interestingly enough, going forward, Fannie Mae here predicts that absorption and construction will be very close, very similar, that they'll build and absorb about the same amount. We'll see. I don't personally agree with that, but we'll see going forward. All right, so that's Fannie Mae's opinion. All right, now let's take a look at this is CBRE. I like to follow CBRE. They put out a lot of good information. Again, I'll put the links in the video here. Let's see what CBRE had to say. By the way, this is the real estate market outlook for 2022. So this is 2021 and CBRE taking a shot at what they thought was going to be in 2022. Let's see how they did. So going into 2022, they said record high demand and construction pipeline, right? So there's a tremendous amount of demand for apartments, but they're also building a lot. Talked about that. All right, so the U.S. multifamily sector is poised to finish 2021 with overall occupancy and net effective rents above pre-pandemic levels. I agree. We saw that. But I also don't think at the end of 2021, my opinion, that we really started to see the effects of COVID and the stimulus money. I think we were still in 2021, we were still on a financial sugar high. And I don't think that we had financially sobered up yet as an economy. And so I think that year we kind of have to look past that year a little bit as far as actual records are concerned. All right, so economy is still growing, boosting household formation. Right. So when there's that much M1, there's that much cash in the world, everybody has some money. I already said that. Well, what we saw were a lot of young people going out and establishing new households at a higher rate than we've seen in the past. So everybody that turned 18 was able to go out and get their own apartment, no roommates, get their own place, right? Well, that's because they had so much wage growth in M1. If that reverses and the wage growth is not there, the rents continue to go up in rate, or the economy slows, or we don't have as much employment, things of that nature, you will see people start to get roommates. This is what I call social stacking. I made that term up, but you will start to see people socially stacking up on top of each other. Whereas they spread out when there's a lot of economy and good economy, they come back together and move up on top of each other when there is less money in the world. I believe that we were heading into a world where there will be less money. So therefore, I think we will see rents decline, but we'll cover that in a minute. All right. So again, this is the outlook for 2022 from CBRE. Here we are. Construction will remain elevated in the near term. Interesting. It did. Completions in 2021 will likely reach a new high, and another 300,000 units will be delivered in 2022. They were wrong. It's actually a fair amount more than 300,000. It's closer to 400,000 that were actually delivered. So their projection was a little low. And they were saying that was going to be strong. So construction was even more strong than CBRE had anticipated. What we're starting to see this afternoon is now some cities are having negative absorption. Okay, that means that the absorption is less than the demand, or the demand is less than the available units out there. So they've built more units than are currently being absorbed. That will certainly lead to a supply and demand issue and could lead to rent decreases as units go vacant. But that will be market specific, city specific, and we'll have to see what goes on there. So again, they're predicting strong demand. Volume of new A-class products coming online will limit the performance of higher quality assets. Agreed. Okay, they're spot on with this one. So as the A-class buildings get built and built and built, because nobody builds affordable housing anymore, right? Everybody's got to go build something brand new in A-class. What you will see is they overbuild, and they don't stop building until they overbuild, right? Builders don't build to need, they build to available funds. So as long as there's available funds, builders are going to build. It doesn't matter whether they need to build, they're going to build. And they tend to build and bust, right? They build until all of a sudden they don't need it anymore. And then you see vacancies for a while. In the A class, what you will see are concessions. You'll see vacancy and then concessions, right? If we're talking about the C and the D class on the more affordable housing scale, what you'll see is in a bad economy, you'll see collection issues and vacancy in those properties there, usually collection issues. All right, so still strong demand going through. Overall project, 8% growth in urban effective areas. So all of this maintained pretty correct for about half the year. And then I would say about half the year when they started to raise the rates, sort of about midsummer or so, a lot of their predictions here started to go the opposite direction and ultimately became untrue. There's a lot of information here. I won't be going through all that. Certainly check out the report. All right, so going in after the mid-year, that's where we started to see the rates coming up, and we started to see transaction volume slowing down, right? Oh yeah, this is another one here. I meant to show you this. Apartment construction reaches a 50-year high. Okay, so that means right there, we've built more apartments than, at this rate at a 50-year high. Let's look at some of the cities real quick. So you have Atlanta, which is known for overbuilding, build and bust, known for that. Okay, we have Phoenix, also a super hot market that we saw a lot of growth in that we've now seen to calm down. California markets have certainly sort of cooled off a little bit. New York, rents have leveled off there, some with some occupancy issues. Florida, Tampa, Miami. I'm in Tampa now. I'm in Clearwater, Florida. We're still seeing rents have pretty level there, pretty stable, but a lot of construction. So you can see a lot of your construction markets here. By the end of 2022, they're expected to be no less than 420,000 new apartments. Now remember, CBRE at the beginning of the year predicted 300,000, and now they're saying no less than 420,000. So it was a lot of apartments, a 50-year high built. Is that again going to cause an overbuild situation? Don't know. Are we going to be overbuilt in affordable housing? No, I don't think so, in my opinion. Are we going to be overbuilt in the luxury A-class apartments? Yes, I believe so, my opinion. All right. So anyway, that's sort of what we're seeing there. Now let's talk about rent. As it's saying, as they're building more units and bringing these things on, are we going to see the absorption, and will we have certain areas really level off in that rent growth? And my opinion is yes, you are going to see rents level off in a lot of markets and maybe even decline in some. So we look in here. This is from rent.com. You can kind of see the different trends. Let me find my legend here. There we are. So change month over month and year over year, and then median rent. So the bars are median rent. So we can see with the rent was just steadily going up, and this is from 2021, October 21, 22. So you can see the rents are steadily going up each month, but then here they sort of peak out, and now we've just started to see the rents decline a little. Now note, they are still way above pre-pandemic levels. So year over year, or year over 2 or 3 years, they are still very high, but the trend is now they are starting to grow at a much less rate. So we can't say the rents are down, they're just not going up as fast. So now year over year change here, you can see that's a 12.2% growth year over year. By the way, I still think that's very dramatic. National average has been around 3-4% for years, and all of a sudden it goes to 15% in 1 year, and that didn't surprise anybody. It should have. All right, but look here, month over month is only 1%, and then here month over month is negative 2.48%. So we're starting to see that rent cool off. I think again that is going to do with a lot of things just getting expensive in the world. People with variable debt, credit card payments, car payments, things like that. Those payments are starting to go up, and so our renters may be financially squeezed, especially if they're having to pay more in fuel, food, education, utilities, things of that nature. Rent eats first, but at the same time, you are going to have to keep an eye on that. Okay, so we can see this year over year change here again, starting to kind of drop down year over year, and then you see here declining. So just something we want to keep an eye on going forward. Supply and demand is a tremendous concept in real estate, making sure that we know what to expect going forward. Okay, so looking at it here, this is kind of multifamily construction, or excuse me, purchases, sales volume. So let's take a look at sales volume for the year. Sales volume from 18 Q1, you can kind of see is up and down, but largely up and to the right. And then all of a sudden, it drops down through the pandemic. We saw a lot of deals all fall apart, pencils down. People were under contracts falling out left and right. We saw a tremendous amount of that into the pandemic. And then coming out of the pandemic, that just absolutely exploded. All that pent up money rushed into the market, as well as all of the M1, which I've pointed out repeatedly. All of that made a lot of people limited partners willing to invest passively, made a lot of people want to become general partners, syndicate deals. and bring on capital. And so that was all well and good. We saw the transaction volume through about half of the year increasing pretty steadily. Then the rates started up, and that's where you can see right here at that last little part where the transaction volume has declined and has continued to decline through the end of the year. We're in January of 2023 at the time of this recording. But point being is transaction volume at the moment is down. Now, historically, transaction volume and deals coming to the market are always going to be a little more depressed during the holiday season, through October, November, December. Transaction volume is always lower there, and deal flow is always a lot lower there. You will typically see more properties come back to the market around February or so. February, March, when the weather warms up, you typically see the transaction volume as well as deal flow pick up. This year, the issue are the massive rate increases. And what that's caused is a huge spread in the bid-ask gap. All right. That is the difference between what people are bidding for real estate and what sellers are willing to accept. So the bid and the ask are getting tremendously different. If anybody's out there looking at multifamily right now, you are probably looking at a lot of deals that make no financial sense whatsoever. How do I know? So it's like, right, a lot of these deals just don't work financially. That's because the rates have made the capital stack, or the amount of money that you have to borrow to get this deal done, so expensive that the deals don't work anymore. A lot of the deals, if you reverse the interest rate back to say 3%, they work fine. You put the interest rate at 7 or 8%, they don't work at all. Well, that's what we're seeing here in really slowing down the amount of transactions and deal volume being brought to the market. It's kind of a seller strike is what we've heard. We'll see. I've always said, hey, buyers don't have mortgages, sellers do. So yes, the transaction volume is down right now. I agree. But here's what we're going to watch is loan maturity. And I'll talk about that in the outlook for 2023. But you're going to want to start watching loan maturity and see when people's loans come due. That's going to be a big motivator for sellers going forward. So again, you see some stats over here. This is kind of what we saw going through 2023. That's multifamily, office, industrial, other reports in here that I won't cover. Office certainly has had a hard time, with occupancy and recovery from COVID. So I'm glad I'm in the multifamily space and not the office space. All right, so that is sort of our outlook for 2022. Or our review of 2022. What did we see? Well, we saw a tremendous amount of inflation. Why? Because M1. Why did M1 blow up? Well, because of COVID and lockdown, and I just don't think the government knew how to respond. So now they are trying to raise the rates, or not trying to, they have raised the rates in order to try to absorb back all of that money. Therefore, we're going to need to be a little careful going forward. All right, 2023, what are we looking at going forward into 2023? Now, this is completely my opinion here. So I'll give you some things that I'm doing. Number one, buy for a long-term hold. Right now, at the rates the way they are, you probably are trying to buy an asset that you are not going to sell for 3 to 5 years. A little bit of a catch there. So you should go out and get a 5 or 7 year mortgage to make sure that your loan doesn't come due in a down cycle. Yes, but if you go get a 5 or a 7 year mortgage this afternoon, are you just locking in a really high interest rate for the next 5 to 7 years? And the answer may be yes, you are. So that's a little bit tough there, but I am suggesting that you be careful about short-term loans because they may come due in an off market when the values are off. I've had that happen in my own portfolio. So I'm saying buy for long-term hold right now. Quality of asset, flight to quality. I'm saying you really want to be in newer buildings, probably 1985 or newer, things of that nature. That is, again, my opinion. The reason that I'm saying be careful about these older buildings is several reasons. CapEx Tsunami, or capital expense. You can watch the last video I created, and it's about capital expense asset problems in America. These older buildings are going to have a cost basis problem, right? The amount of money that you have to buy them for, the amount of money you have to put into them is going to exceed their value. That's because the buildings are having infrastructure issues. So I'm saying stay away from older buildings that have infrastructure problems, because you're probably going to wind up spending a lot of money on that. So don't do value add. That's my next point. I think it is not the time for value add. I know that's probably blasphemy for a lot of people. I understand that, but there is a time to renovate and enforce value, and there's a time to buy for value. And today I'm saying buy for value, buy at a discount, or wait until an asset is distressed and then move on it. To try and go in and do renovations right now and then increase rents to justify the renovation, I believe is a extremely risky proposition, because you're definitely going to spend the money. You may or may not get the rents. So I would be careful about that. Maybe watch your rent growth, maybe give it a year or two, and then come in. If you're going to go out and do value add properties, or if you want to get into the more affordable housing space, then I am strongly recommending that you use creative financing, which is from my book here, Creative Cash. Use seller financing, match lease options, things of that nature. That's what you're going to want to do to mitigate the risk of those older buildings that may have a lot of capital expense needs in there. So I would caution you about going out and getting a mortgage on a very old building. That lender is probably going to make you really fix it up, force a lot of escrows. And the issue is they may not even come in there and give you a hard time about it until the second or third year into the deal. And then all of a sudden they have this big honeydew list of things for you to do on the property. And that can absorb a lot of your cash flow going forward. Again, I have personally had that happen. All right. So I think going forward into 2023, we are going to see rent growth in a lot of the markets level off. In some areas, you are going to see the rent decline. You need to watch your occupancy. Stay on top of your property managers, stay on top of your asset managers, keep an eye on occupancy. There are 3 reasons, and only 3 reasons a unit is vacant. Again, I've put this in other material, but the 3 reasons a unit is vacant, it's either the rent, the marketing, or the condition. Make sure the unit is rent ready, okay, assuming that it is. Now, before you test the price, before you go dropping your rents because maybe you're having some occupancy issues, test the marketing. Make sure your marketing is really good and firing on all cylinders. If you've got your marketing house in order, then lastly, it could be that your rents are too high. You may have to run a concession or lower the rents. So just keep an eye on that, and don't get arrogant and cocky and wait until the problem is a real problem and then all of a sudden just panic and drop your rent to hurry up and fill the property up. I've had partners react that way, and it's always difficult, and it usually results in a mistake. So I would say don't let your occupancy get low, panic, drop rent, and then move in a whole bunch of tenants. You're going to wind up watering down your tenant base. Heads in beds is just never a good business model in multifamily. So pay attention to that going forward. Reevaluate your exit strategies. So if you're coming up on an exit strategy for 2023, 2024, something like that, I would certainly sit down and take a look at your previous exit strategy. If you're looking to sell or have a refinance event in the next year or two, always remember 1.25 debt service coverage ratio. So if you're going to refinance your property, you need to look at your asset and calculate a 1.25 debt service coverage ratio on the refinance price. Chances are you may not be pulling money out. You might be doing a lateral refi. So keep an eye on that. If you're looking to sell, take your sales price and your NOI and calculate a 1.25 debt service ratio. Your buyer is either probably going to lower your price or have to put down a whole lot of down payment. Sell it to yourself. That's what I always say. If you're looking to sell a property, sell it to yourself. Would you buy it? Is it a good deal? Because if you wouldn't buy it, chances are somebody else isn't as dumb either. So, sell it to yourself. That's a good way to head check your exit strategies. So look for debt maturity. I think this is where we're going to have a tremendous amount of opportunity in 2023, in 2024 going forward. As loans come due, these sellers are going to find themselves in a distressed scenario and become motivated sellers. A lot of people that bought deals and went out and got short-term loans, 2-3 year loans over the last 2 or 3 years, got short-term bridge debt, interest only, a variable rate loans, things of this nature. And a lot of those deals were not underwritten for a 7 or 8% interest rate exit strategy. I mean, they weren't. Nobody was buying property 2-3 years ago thinking, gosh, I'll refinance at 8% in a year or so. Nobody thought that, right? But that's the reality now, is that they're going to have to go from that 3% to that 8% refinance. And that's going to make some very motivated sellers. So if you're a buyer out there, I strongly recommend you kind of watch the market, build your relationships with the realtors. Realtors are usually the key. If not realtors, then you want to be trying to reach out to owners directly, but look for loan maturity. If you can track that data in certain avenues, CoStar, other places like that, I certainly recommend you do it. Again, really get out there, build your relationships, network. For deal flow, I think it is going to be slow, somewhat distressed. Strongly recommend commercial realtor relationships. They are the people who know the buyer, the seller, excuse me, they know the sellers, they know who's in distress, they know whose properties are and are not operating well. So relationships with your realtors are a way to get ahead of deals before they come to the market. And lastly, network like crazy and get ready to buy. Okay. If somebody handed you a really hot deal this afternoon, could you close it? Do you have the money? You're out looking at deals. You ever thought, can you even pay for it? So it is good that you go out there and look at deals, but you also have to be able to pay for it. Remember, there are only 3 things that you need to be able to accomplish in this business. There are only 3 things that make any difference: deal flow, deal analysis, networking. You got to have deals coming in the door. You got to be able to analyze those deals and know what you're looking at. And then you have to be able to pay for them when you have a good deal. Deal flow, deal analysis, networking. Those are your 3 things. If you'll do that, you'll be set up for a stellar 2023. Build your team, get your equity together, and get ready to buy. I really think it's been a tough year, and I think 2023 is going to be a tough year as well. But I also think we're going to have a lot of opportunity going forward for those who know what they're doing and for those who are well funded. So again, thank you for joining me. You can check out my books on Amazon, Real Estate Raw and Creative Cash. If you need some help, certainly reach out to myself or Monica Wyndham. We'll put our contact information here. See you next time. Take care.